Morning, everybody. My name is Bennett Tchaikovsky, and welcome to This is Intermediate Accounting 17th edition video solution walkthrough Kiesel, Weingart, and Warfield, problem 23-3. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 and 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky, not the authors of the textbook or Wiley. So the first thing I want to say is that this is a question that's asking us to prepare a statement of cash flows using the direct method. What we're going to go ahead and do is probably go through and prepare the other parts of the schedule first. And then we'll kind of go ahead and go from there. So let's go ahead and do it. So again, the first thing we're going to go through and do is when we're preparing a statement of cash flows. So we have Mortensen Company statement of cash flows for the year ended 12/31/20. Cash flows from operating activities, total cash or net cash, blank operating activities. Cash flows from investing activities, net cash blank investing activities. Cash flows from financing activities, net cash blank financing activities. Okay, our total change in cash. So our cash to go up or down. Cash started at 100, ended up at 333, so it went up by 233. My beginning cash balance was 100. My ending cash balance is going to be 333. I have non-cash transactions. Okay, so this is my skeleton, and this is what I always want to go through and first start up with. It's basically telling me the outline of the statement, and then I'm going through and then having this additional information below. If I'm preparing a direct method statement of cash flows, the only thing that's different between direct and indirect, which is the method that I definitely prefer to see done, is the operating section. So let's go ahead and set up our T accounts. Just give me a moment. Okay, so we've got over here, we have US. So what I'm going to do now is I'm going to basically create T accounts. So I've got operating, I have investing, and then I have financing. Okay. So over here, we have US Treasury notes. Opening is 50, ending is 10. We have accounts receivable. Opening is 500. Ending is 780. Inventory. Opening is 70, ending is, opening is 560. Whoa, Bennett, you're losing it. 560, ending is 720. Land opening is 70, ending is 150. Buildings and equipment. Opening is 600, ending is 910. Accumulated depreciation on equipment. Opening is 120, ending is 200. Over here, current liabilities, my accounts payable started out at 330, ended up with 420. My income taxes payable, opening is 30, ending is 40. My notes payable, opening and ending are 320 and 320. My long-term notes payable, opening and ending are 200, 200. Then we have common stock. Opening is 700, ending is 1300. And then we have retained earnings. Opening is 310, ending is 528. Okay. So that takes care of our different items over here. And let's take a look. Now, this is an interesting question. So this is basically saying there's no additional information. So let's have some fun. So I'm going to go ahead and prepare this using the indirect method first to see if we can get our cash to balance. So let's go ahead and take a look at this over here. So looking at this over here at the income statement. So our net income was 818. But what's interesting, so this is going to be net income is going to be do the opposite to cash. This is my cash T account. So typically when I have when I'm doing this, I will go through and we'll deal with the additional information first. And hopefully I didn't make a mistake, but I think this is all the information we have. So what I'm doing now is I'm kind of going through over here and seeing what happens. So this is a fun one, stock dividend declared and issued. Okay, so when a stock dividend is issued, you're basically what you're doing is you're saying stock dividends, which is like a normal dividend declared. And then you'd have like an account called, I think it's like common stock payable. And then when it's distributed, but at the end of the day, when you're issuing stock, you're basically going to be debiting stock dividends and you're going to be crediting common stock. Now, if this amount over here is 600, right? So I'm basically debiting a dividend, crediting common stock. What this is actually a non-cash transaction. So I can say here and say, we can say issued and declared a 600,000 stock dividend. So this is a non-cash transaction. Okay, so that's a non-cash transaction. And then let's go ahead and look at the other T accounts. So right over here for US Treasury notes, I don't think there was a gain or loss on any of the notes. So basically what we can do here is we can credit this for 40. What I can say is over here, sale of Treasury notes. And then we'll go ahead, debit the investing section for 40. Accounts receivable, it went up. So I'm going to do the opposite to cash or go over here and do this at 280. This is an increase in accounts receivable. If I'm going over this really quickly, it's mainly because this is kind of, I don't want to call it a throwaway question, but it's not a question I would ask, mainly because I would just kind of take a look at the other videos and you can watch me go through and do it. But hopefully this helps. Inventory went up by 160. So we're going to do the opposite to cash. We describe it by what's happening in the T account. This is an increase in inventory. Okay, land went up by 80. This is going to be a purchase of land. Okay, over here, I see that accumulated depreciation on equipment. So this actually went up by 80. So this is going to be my depreciation expense. Buildings and equipment went up by 310. So this is going to be a purchase of equipment. Accounts payable went from 330 to 420, or an increase of 90. So this is going to be an increase in accounts payable. Okay, of 90. This is income taxes payable. So as you can, if you remember in terms of watching the other videos, right, the way you do cash flows is we start with our T account, assets equals liabilities plus owner's equity, DC, ER, right? Record expenses with debits, revenues with credits. Assets typically have debit balances, are increased with debits, decrease with credits. Liabilities and equity accounts typically have credit balances, increase with credits, decrease with debits. So when I come over here and I am looking at this particular question, right, there was no additional information. So my typical way that I'm going to go and analyze, I do these questions, I'll do the skeleton. So I know that my total change in cash has to equal whatever the amount might be. I then set up T accounts by entering in the beginning and ending balances. Now with this particular question, there's no additional information. So without that additional information, yeah, I'm kind of, it's not that I'm flying blind. It's just that, you know, I'm just looking off this and making assumptions. So what I'm doing now, which is usually my last stage, is analyzing each of the accounts. If buildings or equipment increase, this is an investing activity. I do the opposite to cash or credit it for 310. Land, purchase of land, accumulated appreciation on equipment. Basically, this is going to be over here. And I am looking at this, and did I miss the patent? Oh, wow. Okay. So my patents, wow, I missed a T account. So I have patents of beginning 130, ending 105. Okay. So let's just keep going. Accounts payable, income taxes payable. So an increase in income taxes payable and income taxes payable. It's going to be a 10. Notes payable, no change. Long-term notes payable, no change. Common stock is balanced. Retained earnings is balanced. For my patents, I need a credit over here of 15. So I'm going to go ahead and debit cash for 15, and this is amortization expense. Or actually, no, this is actually going to be 25. Good job, Bennett. You're really with it this morning. Okay. Amortization expense is going to be 25. So after I've made all those mistakes, let's see where we are. And our magic number is going to be 233. So if I look over here at financing, there's nothing going on, but I'm going to check my numbers real quickly. Long-term notes, notes payable, we're good. Okay. So nothing going on with financing. With investing, we had total over here of 40. So we got 350. On the income side or on the operating side, so right over here, I've got used in investing and provided by operating. And so if I look at both of these over here, the magic number we're looking for is going to be right over here. We got it to balance. Perfect. Okay. So now that I know that I've done that correctly, right? So I did this is indirect method, by the way. So if I was to do indirect method, you've seen me do this in other questions before, but let's just go ahead and do this part with the investing. So I've got sale of treasury notes at 40. These are going to be negative amounts because they are on the credit side. So we've got over here purchase of land. And then we've got purchase of equipment. So we have net cash used in investing activities of 350. Okay. So I know that I got this to balance, right? So I know that my answer for the direct method has to be 583, because if I use 583 up here, I know that I'm going to get down over here to the 233. Okay. So let's go over here. And we kind of developed a new methodology for dealing with, it's probably not new. It's probably, I don't know, you kind of figure it out. So when we're dealing with the operating section, we're going to be taking things like sales revenue. And this is 3,800. We have cost of goods sold, which is negative 1,200. Heat, light, and power, salaries and benefits. I'm going to kind of assume changes in accounts receivable and accounts payable relate to cost of goods sold. Okay. Changes in accounts receivable. Okay. So I'm also assuming too, the inventory is going to be relating to cost of goods sold. So salaries and benefits, I don't really need to convert anything like that. But we also have down over here, we have income tax expense. And this was negative 818. What I'm going to try to do is convert each of these into cash received from sales, cash paid for COGS, and then cash paid for income taxes. So what I'm going to do is I'm going to come over here, and if it is a debit that I had to do to balance in the T account, I'm going to go ahead and make it a negative amount. So AR, so my cash received from sales is going to be 3520. Over here for cost of goods sold, I actually have two different accounts that impact it. I have accounts payable and I have inventory. So accounts payable, I'm going to show this as a positive amount over here because it was a credit. So I'm going to show it as a positive here. If it's a debit, I'm going to show it as a negative. My inventory went up, so this is going to be a negative. Okay. So, and for my income tax expense, my income tax payable went up by 10. So I'm going to show this as a positive. So my cash paid for income taxes is going to be 808. My cash paid for cost of goods sold is going to be 1270. And we have cash received from sales of 3520. Now, the reason why, and if you think about it, this is by far the best way to go. You take these accounts, you come over here to, you're trying to get cash received from sales. You look at the T account. If I had to debit it to make it balance, I just show it as a negative here. If I show it as a credit, like accounts payable, it's going to be a positive amount. Okay, if it's a debit, it's going to show as a negative here. So that's what I'm trying to go through and do. Now, we know that when we add these numbers up, there's a magic number where we are trying to get to, and I did not get us to that number. And let's see why. Okay, so now I'm going to assume here that what was the mistake that I made? Well, this is usually just reconciling the main accounts, but what I really didn't do over here is that there's other accounts like salaries, cash paid for salaries and benefits. Cash paid for heat, light, and power. Cash paid for property taxes. So let's see if so right over here, my cash paid for salaries and benefits, cash paid for heat, light, and power was 75. Cash paid for property taxes was 19. And I'm also going to go ahead and let's just kind of add some more of these up. It's kind of fun. So yeah, because I screwed up a question. Absolutely. Let's dig into this. This is fun. Okay, so right over here, at least it's fun for me. Okay, so I've got, now when I'm just kind of going through and doing, so depreciation is a non-cash item, so I'm not really worried about that. Property taxes generally are going to be heat, light, and power, cash, salaries and benefits, miscellaneous expenses or miscellaneous. This is going to be negative 10, cash paid for interest. We'll see what that works out. Minus 30. Okay, now let's take a look to see if we can get this to balance. So if I take 3520 plus 1270, or less 1270, less 725, less 75, less 19, less 10, less 30, less 508. Oh, look at that. Oh, way to go, Tchaikovsky. You got it to work. This is why, children at home, we will always want to go through and do the indirect method first, because if we go through and we screw up, we can see what our problem is. So I was so focused on all the other examples of that, you'd have sales and cost of goods sold. That's what you go through and reconcile, right? But in reality, you have to go through the other items on the income statement. But what's important for us is to go through and discern which of these items are cash basis and which do not have an impact on cash. So depreciation, not a cash item. So we're not going to go through, that's not cash paid for depreciation. Patent amortization, no, that's a non-cash transaction. So yeah, there you go. It's exciting. So in any event, I want to thank you all for joining me here today. No accountants were harmed in the making of this video. And I want to thank Wiley for allowing me to use their material. So, hey, have a great day. Make it a better tomorrow. And I will see all of you on the next video. Good night.